Money FM 89.3. Best of breakfast. The Bigger Picture, only on Money FM 89.3.
Good morning, welcome to The Bigger Picture. And we've got a bit of a lens on real estate across Asia. And this at a time when uncertainty is high, but opportunity is still knocking. We'll be unpacking M&G Real Estate's latest mid-year global outlook, which describes this moment as a rare entry point in real estate. So what's driving that optimism, and how are geopolitical changes, especially the U.S. tariffs, reshaping the global flow of capital? Joining us in the studio is Regina Lim. She is the Head of Property Research for Asia at M&G Real Estate. Regina, good morning.
Morning.
Great to have you here. So let's start there first with that rare entry point in real estate. Can you explain why this moment is seen as a buying opportunity?
Sure. As you know, since the middle of 2022, interest rates have been rising globally. And over that period, we've seen a correction in asset values across the world. And in Asia Pacific, depending on the country and the sector, we've seen values fall up to maybe 20%. So if you buy into it today, you're actually going to get outsized returns. Probably in the next 4 to 5 years, unlevered total return annually of about 8 to 10%. And that's much higher, maybe about double what we would have gotten prior to the correction in 2022. And when you're buying into this entry point and you look ahead, actually the growth is quite substantial, supply is quite low, and the returns are there. The second reason is that with this uncertainty in geopolitics, in government policy, especially coming from the US administration, a lot of global investors are rethinking how they are investing their money, through what ways, and how concentration risks in their portfolios are showing up. So I think it's going to lead to more capital in the next few years, thinking about regions other than the US. The dominance of US as a destination for their capital is going to come into question. And even in real estate portfolios, they realize that much too high a proportion of their portfolios is in US real estate. And maybe that cannot be justified anymore. And the third thing is actually with this uncertainty, we've seen a downgrade in economic outlook in GDP forecasts globally. But the biggest hit is actually in the US itself. Its economy has been downgraded. Economists believe that growth in the next 2 years will be less than 2%. And yet when you look at Asia Pacific, growth is largely intact. About 55% of total trade volume is intra-regional because we ourselves have been collaborating. We have a lot of trade with China, which is going to likely continue. And we're going to work even harder to work together with each other to generate stronger growth for the population here in Asia Pacific. So I think when I look at it from this point, from capital flows, from growth, and from the pricing, it's all pointing in the same direction.
Yeah, Regina, so you kind of answered part of my question I had in mind, which was the flow of capital, because folks investing in the US are now channeling some of that to Asia. So as what I've described, is that offsetting perhaps folks who are feeling uncertain about the economy, holding their investments back, waiting for clearer times ahead? So you're saying that reflow or capital flow being reshaped in that sense, coming to Asia, is going to offset that uncertainty?
So I think it's in different aspects. One is that when you think about the last 20, 30 years, we've got globalization, a lot of trade, and a lot of growth and very low inflation. A lot of goods were made in China, and that kept costs low globally. In this very low inflation, low interest rate environment, we had negative correlation between equities and bonds. And so a lot of people will hold a 60-40% portfolio, and that would do very well. But in the last 2-3 years, you found that correlation between bonds and equities has actually increased. And going back to a period of higher inflation, higher interest rates, this negative correlation may no longer hold. And so investment managers are thinking about how do we diversify out of equities and bonds. Maybe we buy more gold, maybe we buy more commodities, maybe we buy more real estate. So I do think that people will start to put more of their global portfolios into other asset classes like gold and real estate. The second thing is within real estate portfolios. When you think about where's the real estate, about 37% of global income producing real estate sits in the US, 30% sits in Asia, and then the rest in Europe. And when you look at the MSCI assets under management in the real estate funds, 2/3 are invested in US. Only 15% is invested in Asia Pacific. So when you think about a pension fund sitting in Europe or Asia and looking at their exposure within their real estate portfolio, to go like, why are we holding so much real estate in the US? If I was a Korean or China pension fund, I would think every year I'm spending $100 and I'm putting $65 into US real estate, when actually a third of global income producing real estate is right here in my backyard. And I should think about the growth, which is much stronger than the US. And I should think about the fact that more people are not going to use US as the default destination for investment. And I want to be ahead of the curve.
Okay.
The second reason I'm talking about this is that when you look at 2024, 43% of global investments into real estate came from Asia-Pacific investors, Asia-Pacific insurance, Asia-Pacific pensions, Asia-Pacific sovereigns. And this is the bulk of the global capital going into real estate. Why are they not going to refocus their attention back to Asia-Pacific real estate and keep pushing it into the US? Actually, something has changed this year. You know, in Korea, NPS, which is the National Pensions, and Korean Post, they are setting up new funds to invest into domestic Korean real estate because actually, historically, they have done a lot of investments into the US.
Okay.
And I think more of this could come into play.
So more flowing into Asia. So let's zoom in on where particularly. And you have Japan at the top of the list. I'm wondering as well how much the yen plays a factor there, because we've seen an appreciation of the yen versus dollar, some 6+% year to date.
Wow, still very low though. People are still going to Japan to eat sushi. I think my view on Japan is that they have tried so hard for 30 years to get a bit of inflation in the system, and they finally succeeded. And that's through many, many ways, through corporate restructuring, through encouraging more gender pay equality, putting more women into the workforce, increasing the amount of childcare and so on. So at this stage, we finally have, in the last 3 years, wage growth, right? And we have inflation that is going towards 2%, which is pretty healthy, that the central bank wants. The rise in inflation is something of a spanner in the works, but I think that's going to come out of the numbers pretty soon. But when you look at what wage growth has been able to do in the last 3 years, it's also started another trend where manpower and labor turnover is now healthy. If you spoke to someone 5 years ago about changing jobs in Japan, it would sound like a foreign idea. People stay in their jobs their whole life.
Yeah, things looking up.
Yeah, so if people are changing jobs to get higher pay, and if we're getting consistent wage growth, we are seeing it in the residential rentals. So multi-family rentals in Tokyo are up 5% last year and 8% year-on-year in the first half of 2025. Now, this is a sector where for 15 years we've been investing in it. The rental is 1% every year for multifamily. So this change in rental is going to also, with the changes of prices of ramen and changes of wages, be in a circular positive symbiotic trend. And the government just came out last month to say that we are targeting 1% real wage growth going forward. So they are hoping that wages and the corporates to cooperate to get wages to grow 1 percentage point higher than inflation, which is around 2%. So you're going to get wage growth consistently of 3% or so. And that's going to go into the rental growth for multifamily, as we've seen in the last 3 years.
So structural reform is paying off and manifesting in that part of the real estate equation. Let's talk about what's paying out as well. Trade tensions and tariffs and so on. So where does the logistics and industrial properties sector come into this equation? Are you favorable on that part of the spectrum?
We do like logistics, but we can see in the last quarter or so, leasing volumes has been a bit more choppy, depending on the sector you're in. And there's also been quite a bit of supply in the last 3 years. On the supply side, maybe I'll just address that first. In the next 3 years, supply in Seoul, Sydney, and Tokyo, the key hubs that we're talking about in Asia Pacific, is going to be about 40-50% lower than the last 3 years. So the supply is tapering off, and I think rental growth will be much healthier. The second thing is actually in Asia Pacific, a lot of the demand is coming from modernization, automation and robotics in our warehouses. So as we are buying more things online, we are helping companies to automate and digitalize their processes throughout their whole supply chain. Just an example, in Sydney, the leasing volume was quite healthy in the second quarter, simply because there was a large lease. It was the largest lease signed in the last 5 years from an e-commerce operator with a lot of robotics and automation, autonomous vehicles in their warehouse lease. So this is a reason why we still think that structurally speaking, logistics demand is going to be very healthy, supply is going to be quite low, and the sector is worth investing in. And especially in Australia and Korea, where values have fallen, cap rates have risen, over the last 2 years. So we see it as a really good entry point. And M&G, we invested into a logistics facility in Sydney recently and at a very reasonable price compared to what you would be able to buy 2 years ago.
All right, great snapshot. And Tokyo at the top of the list for now. And we've been in conversation with Regina Lim. She is the head of property research for Asia at M&G Real Estate. Regina, thanks for the time and insights this morning.
Thank you.
All right, stay with us on Money FM 89.3.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance. To listen to more great interviews, download our podcasts at audio.sg or download the audio app. That's AWEDIO, audio at the App Store and Google Play.